You know, usually when a company releases its earnings report, the math makes intuitive sense.
Yeah, generally speaking, you sell more, you make more.
Exactly. You sell more products, you make more money, your stock goes up. It's a very simple, comforting equation.
Right. The market likes predictability.
Right. But then you look at what happened in August of 2026, and suddenly that whole equation completely shatters.
Oh, absolutely. It remains one of the most perplexing market reactions in modern tech history, really.
It really is. So today we are pulling from Google's Q2 2026 earnings reports, a completely wild SEC regulatory filing from SpaceX, and some recent Bloomberg leaks.
Because we need to figure out why the market punished a company for achieving basically absolute perfection.
Right, a total disconnect.
Yeah.
So let's unpack this for you because you really have to understand the sheer scale of what happened here. It's August 2026. Google releases their Q2 earnings, and the numbers are just staggering. I mean, their cloud business grew by 82%.
Which is massive.
Massive. They hit the highest single-quarter profit in the history of human corporate enterprise.
Literally a flawless victory on paper.
Exactly, on paper.
Yeah.
And yet, the very next day, their stock crashed by 7%.
Yeah, a massive sell-off.
So the mission of our deep dive today is to unravel this mystery. Because the answer isn't in the profit numbers, right?
No, not at all. It's buried in a hidden $30 billion contract that explains everything.
Right. We are looking at a secret deal with Elon Musk's SpaceX, and honestly, a terrifying prisoner's dilemma at the heart of the whole AI industry.
It is such a fascinating story. It's fundamentally about the physical limits of infrastructure, corporate desperation, and, well, some of the most aggressive, high-stakes financial engineering we have ever seen.
It really is. But before we get into the mechanics of this massive financial anomaly, I want to share something with you.
Sure.
To access more advanced researches, applications, and our latest Deep Values agent, welcome to explore and join deepvalues.ai. And if you want to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
All right. And as always, a quick note before we proceed. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
Definitely.
All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment or financial decisions.
All right, let's get into it. So the stock didn't drop because of the profit.
No.
It dropped because of some incredibly alarming clues buried deep in the cash flow statement.
Yes, the cash flow statement.
Help us understand why investors were looking there instead of, the record-breaking income statement.
Well, the income statement is essentially a narrative constructed by accounting rules, right?
Okay, a narrative.
Yeah, it can be smoothed out, like you can recognize revenue over time, or you can delay recognizing certain costs.
Oh, I see.
But the cash flow statement is brutally honest. It strips away all the accounting magic and tells you exactly what actual dollars are entering and leaving the bank accounts on that specific day.
Right, cold, hard cash.
Exactly. And in Q2 2026, the sheer volume of actual cash leaving Google's bank accounts was unprecedented.
Unprecedented almost feels like an understatement, honestly, when you look at the raw numbers.
Oh, absolutely.
Their quarterly capital expenditure, what they're physically spending on equipment, servers, and facilities, hit a mind-blowing $44.9 billion.
Just an astronomical figure.
Right. And because of that massive outflow of cash, their free cash flow actually went negative. Negative $5.85 billion to be exact. For a money printing machine like Google, seeing free cash flow go negative is incredibly rare.
Very rare.
I mean, looking at a rolling 12-month period, their free cash flow plummeted from $64.4 billion down to just $5.3 billion.
And that sudden cash drain forced them into a very unusual financial maneuver.
Yeah, this is the part that really surprised me.
Right, because Google is a company sitting on roughly $240 billion in cash and cash equivalents.
Right.
But they suddenly decided they needed to raise more money. They raised $49.6 billion by issuing stock and another $20.3 billion in senior notes.
Wow.
By doing this, they essentially doubled their long-term debt, bringing it to an astonishing $980 billion.
Wait, let's pause there because this makes no sense on the surface.
I know, it really does.
It's like a billionaire with a vault full of gold does not suddenly walk into town to take out PD loans and max out their credit cards, right?
Exactly, yeah.
A company that inherently does not lack money opened up both equity and debt financing channels simultaneously. And what exactly are senior notes? Why would they use those?
So senior notes are basically high-priority IOUs. They're a type of debt that takes precedence over other debts if the company were to declare bankruptcy.
Okay, so they're safer for the lender.
Right. They usually carry a lower interest rate because of that safety. As for why a cash-rich company would issue them, it really comes down to liquidity and urgency.
Urgency, huh?
Yeah, a lot of that $240 billion cash pile is likely tied up in investments or held in overseas accounts.
And bringing it back to the U.S. would trigger massive tax penalties.
Exactly. They needed liquid cash immediately without touching those existing reserves.
So what does this tell us? They are borrowing aggressively to fund a $44.9 billion quarterly shopping spree.
Right. It proves the absolute desperation driving the AI arms race right now.
Desperation is a good word for it.
This wasn't a signal that Google's core search business was failing. Far from it. It was a glaring signal to the market that the scale of physical investment required right now is so astronomical that even a $250 billion cash buffer isn't enough.
Wow.
During the earnings call, the CFO explicitly referred to this as a supply-constrained environment.
Supply constrained.
Yeah. They are desperate for compute power, and that desperation is what led forensic accountants to discover the hidden contract.
The fire contract, as it's been called in the financial press.
Yes.
This is the $30 billion secret. On June 5th, a regulatory filing from SpaceX revealed something wild.
Truly wild.
Google is renting 110,000 GPUs, CPUs, memory, and related network components directly from SpaceX. And the rent is $920 million per month.
Nearly $1 billion in rent every single month.
It's unbelievable. The lease runs from October 2026 to September 2029.
Mhm.
If you calculate the total over that period, assuming they utilize the full capacity, it's roughly a $30 billion commitment.
That's a huge commitment for a rental.
Right. A Google spokesperson gave a very brief explanation, saying it was a transitional strategy to ensure they have the capacity to meet the demands of their AI agent platform, Gemini
It's
Enterprise.
transitional strategy, right?
But wait, here's where it gets really interesting for you as a listener, because you have to think about who Google actually is.
Exactly.
Google literally invented the TPU chip, the tensor processing unit. They lay their own undersea internet cables.
They're infrastructure giants.
Yeah. They operate dozens of their own hyperscale data centers globally.
Yeah.
Why on earth is a company that just spent $44.9 billion on its own infrastructure going to a rocket company to rent NVIDIA graphics cards?
It seems backwards.
Right. Do they just not have the chips?
That is the exact assumption most people make, but it's fundamentally incorrect.
Really?
Yeah, the bottleneck in the AI industry right now is not the chips themselves. Google has plenty of chips.
Okay, so what is it?
The genuinely scarce resources are the electricity and the physical facilities equipped to handle that specific, intense power load.
Wait, I need to push back on that. Google has TPUs. Why do they specifically need to rent 110,000 NVIDIA GPUs? Is there a difference?
There is a big difference. While Google's TPUs are incredibly efficient and custom-built for running AI models once they are trained, NVIDIA GPUs are currently the universal Swiss Army knife for AI development.
Oh, I see.
Almost all of the world's leading AI researchers and software ecosystems are deeply entrenched in NVIDIA's programming architecture.
CQD.
Exactly, CDA. If Google wants to attract top-tier enterprise clients and offer the most flexible training environment, they have to offer massive NVIDIA GPU clusters.
That makes sense.
But as I mentioned, the real issue isn't acquiring the GPUs, it's plugging them in.
Right.
Google could buy 100,000 GPUs tomorrow, but they couldn't get a new data center fully permitted, built, and powered on by the local grid within a 12-month timeframe. But SpaceX could.
Which is just wild to think about. A rocket company beating Google at data center logistics.
It really is.
I read that SpaceX took an abandoned appliance factory and converted it into a massive AI training center in just 122 days.
Yeah.
How is that physically possible?
It's an engineering marvel.
Yeah, I mean, according to Jensen Huang, the CEO of NVIDIA, SpaceX managed to install 100,000 GPUs in just 19 days. That is normally a 4-year process.
It is an infrastructure miracle, honestly, and it comes down to engineering culture.
How so?
You have to remember, SpaceX is an aerospace company used to vertical integration and brutal round-the-clock timelines.
Right. They build rockets.
Exactly. When a traditional tech company builds a data center, they hire outside contractors, wait for municipal permits, and rely on standard supply chains.
Lots of red tape.
So much red tape. SpaceX didn't do that. They brought in their own engineers. They prefabricated the complex liquid cooling manifolds the plumbing needed to keep these chips from literally melting off-site and snap them together like Lego bricks.
Wow.
They treated a data center build like a rocket launch countdown.
Okay, but what about the electricity? You mentioned power is the main bottleneck.
Mm-hmm.
We are seeing Google, Amazon, and Meta face massive delays because municipal power grids just don't have the capacity to hook up these gigawatt facilities.
Right.
So how does SpaceX get around the grid wait times?
By completely bypassing the traditional grid.
Wait, really?
Yeah, SpaceX didn't wait in line for utility companies to spend 3 years upgrading local substations. They set up massive on-site solar arrays and industrial gas generators directly at the factory site.
No way.
Yeah, they essentially generated their own power, building a 300-megawatt power island in a matter of months.
A power island. That is incredible.
So what SpaceX is actually selling to Google isn't compute power. They are selling time. In an AI arms race, having capacity available today rather than 3 years from now is worth billions.
I see the logic, but that naturally forces a massive question.
What's that?
Building a 300-megawatt power island and racking 100,000 GPUs is incredibly expensive.
Yeah.
Why does Elon Musk have all this spare capacity just sitting around?
Good question.
He certainly didn't build the world's largest single AI training facility just to bail out Google.
He absolutely didn't. According to a June 12th report from Bloomberg citing people familiar with the matter, SpaceX did not build this facility to become a landlord.
Okay, so what was the goal?
The original plan was highly ambitious. They wanted to connect 3 distinct data centers across different locations together to create one giant unified cluster to train their own cutting-edge model, Grok.
But they couldn't pull it off.
Right, no, they couldn't.
The Bloomberg report mentioned it failed because of severe latency issues. Break that down for us. Why is latency fatal to an AI cluster? Normal cloud servers are spread out all over the world, right?
Yes, they are, but training an AI model is vastly different from hosting a million separate Netflix streams.
How so?
When you train a massive AI, the chips aren't working independently. They have to constantly share data, weights, and parameters with each other billions of times a second. They have to act as a single synchronized brain. If one GPU is waiting even a few extra microseconds for data to arrive from a facility 10 miles down the road, the other 99,999 GPUs have to pause and wait for it.
Microseconds. That's insane.
Yeah. The older network infrastructure simply couldn't handle the data transfer speeds required. They couldn't sync the 3 separate centers.
Oh, that makes perfect sense. It's like trying to conduct a 100,000-piece orchestra, but a third of your musicians are sitting in a different concert hall being broadcast in via satellite.
Exactly.
Even a half-second delay turns the entire symphony into complete noise. The music just stops.
That is an excellent way to visualize it. The synchronization is everything.
Right.
So when the latency issues proved insurmountable, the massive distributed cluster plan essentially collapsed.
So essentially, Musk tried to build a sprawling, hyper-connected mega mansion. But when they turned the water on, the plumbing across the different wings just didn't connect right. The pressure was all off.
Yeah, it was a mess.
So instead of taking a total loss on the property, he immediately chopped the mansion up into fully furnished luxury apartments, and now he is renting those apartments out to his biggest rivals for an absolute premium. That's wild.
It's a brilliant pivot, honestly. Instead of sitting on a sunk cost, Musk turned that failed cluster into a highly lucrative infrastructure business.
Yeah, I'll say.
In May, they rented out a massive portion of the compute to another competitor for $1.25 billion a month. Then in June, they signed the deal with Google for $920 million a month. That is over $2.1 billion a month in rental income across just 2 contracts.
That's staggering.
Musk capitalized on the exact infrastructure bottleneck his competitors are trapped in.
Okay, so Google is paying a massive premium to rent SpaceX's luxury apartment because their own mansion is still under construction and waiting for the power company.
Right.
But when you look closer at the actual terms of this contract, the $920 million one, it gets even crazier. It doesn't read like a standard partnership at all.
No, it really doesn't. The terms of the agreement reveal an emergency contingency plan with heavy distrust on both sides.
Exactly. I want to highlight the escape hatches built into this thing.
Let's do it.
First, if SpaceX doesn't deliver the GPUs by the end of September, basically after a 1-month grace period, Google has the right to immediately terminate the contract or demand a significantly discounted delivery rate.
Right, covering in their bases.
But the real kicker is what happens after December 31st, 2026. After that date, either party can just walk away with a mere 90-day notice.
Just pack up and leave.
Exactly, you can just pack up and leave. Why structure a multi-billion-dollar deal like that?
Because structurally, what Google is doing here is executing an options trade, not signing a traditional long-term lease.
An options trade.
Yes, think of that $920 million a month as a premium paid to buy a call option on AI demand.
A call option, let's make sure that's clear for you listening. A call option gives you the right, but not the obligation, to buy an asset at a certain price.
Correct. In this scenario, the asset is compute capacity.
Got it.
If the enterprise demand for AI models continues to explode, well, Google has machines ready and waiting to capture that revenue. They exercise their option.
Makes sense?
But if the AI bubble bursts, or if the consumer demand doesn't materialize the way they expect, Google can bail out with just 90 days notice.
I see. So it's like paying a massive, non-refundable deposit to hold a luxury venue for a giant wedding that might get canceled.
Exactly.
You're paying a huge premium just for the right to use the space, guaranteeing you aren't left out in the cold if the wedding happens.
Right.
But if the whole thing falls apart, you just walk away from the deposit without being forced to actually buy the building.
Precisely. They have successfully dumped all the heavy asset, long-term risk onto SpaceX.
Oh, wow.
Think about the hardware itself. The servers have a depreciation life of 5 to 6 years. The contract is for 33 months.
Okay.
Even if Google stays for the whole term, when they leave, those 110,000 GPUs will still have half their accounting life left.
Oh, man.
And what to do with aging, rapidly obsolescing assets becomes the landlord's problem, not Google's. Google bought themselves certainty and agility in a highly uncertain market.
Okay, so if Google was smart enough to build in this 90-day escape hatch and they successfully pushed the long-term risk onto SpaceX, why did the market still punish them? Why did the stock drop 7% if this was such a clever defensive maneuver?
Because the market isn't just looking at the SpaceX contract.
They're looking at the big picture.
Right. The $920 million a month is a drop in the bucket compared to the $44.9 billion in capital expenditure that Google is spending on its own permanent infrastructure.
Ah, right.
That $45 billion doesn't have an escape hatch, and it represents a massive depreciation time bomb.
A depreciation time bomb. Let's dig into the accounting mechanics here because this is the exact reason the stock crashed despite record profits.
Right.
In Q2, Google spent $44.9 billion on equipment and facilities, but on their income statement, they only recorded $7.1 billion in depreciation.
Which is a ratio of over 6 to 1.
That's huge.
To understand why this is terrifying to investors, we have to look at how accounting rules treat infrastructure.
Okay.
When you buy a massive server farm or construct a data center, you don't take the financial hit for that entire cost on day one. You spread that cost out over the useful life of the asset.
Right.
As you mentioned, servers depreciate over 5 to 6 years, and the physical buildings depreciate over 25 to 40 years.
So what does this all mean for you listening? Think of it like buying a fleet of incredibly expensive supercars on credit to start a luxury rental business.
Okay, good analogy.
On your monthly budget, you're only recording the first month's insurance premium and a tiny fraction of the loan payment.
Right.
Looking at that ledger, it seems like you have a 34% profit margin today. You look like a genius.
Yep.
But those massive multi-million-dollar bills for the cars themselves are just slowly creeping up the calendar. The money is spent, the debt is incurred, but the pain hasn't hit your profit and loss statement yet.
That is exactly how the math works out. The 34% operating margin Google reported is somewhat of an illusion.
An illusion.
Yeah, it's constructed entirely on the premise that the vast majority of their newly purchased assets haven't started depreciating yet. The costs haven't matured.
Wow.
And this isn't just a Google problem, it is an industry-wide phenomenon.
Really, everyone is doing this.
Yes. If you look at the top 4 hyperscalers over the past 4 quarters, they have a combined capital expenditure of roughly $433.9 billion.
Okay.
But they have only recorded about $149 billion in depreciation.
That is nearly a $300 billion gap, a 3x difference.
And that gap will not magically disappear. It is simply delayed.
Right.
During the earnings call, management was very direct about this reality. They stated that this massive increase in infrastructure investment will inevitably press down on the income statement in the form of higher depreciation and energy costs in the near future. Free cash flow will continue to be under immense pressure. The market isn't pricing in Google's record earnings today.
Right. They're looking ahead.
The market is forward-looking. They are pricing in the absolute certainty that future profit margins are going to be crushed by the delayed depreciation of today's $45 billion spending sprees.
And here's the really scary part, right?
Hmm.
Those depreciation costs are going to hit the ledger, whether the AI revenue actually materializes or not.
Exactly. The bill comes due.
Those costs are locked in by the calendar, not by customer demand. The bill comes due regardless. So when the stock dropped 7%, the market wasn't reacting to Google renting chips from Elon Musk.
No.
The market was asking, how much more money do you have to spend to secure the next wave of growth? And when, if ever, are you actually going to earn that money back?
And the unsettling truth is that neither the earnings report nor the management team provided a clear answer to those two questions.
Why not?
Because they don't know, and that uncertainty is what caused the sell-off. Which brings us to the ultimate takeaway from all of this.
The big picture.
What we are witnessing among the tech giants is not just standard corporate competition. It is a classic prisoner's dilemma on a multi-hundred-billion-dollar scale.
The AI prisoner's dilemma. Explain how that dynamic is playing out right now, because it feels like they are all trapped.
Well, in game theory, a prisoner's dilemma occurs when rational actors are forced into a mutually destructive outcome because they cannot afford to trust each other.
Right.
Right now, every single major tech company, Google, Amazon, Meta, Microsoft, knows that continuing to spend $45 billion a quarter is financially toxic.
It's unsustainable.
They know it will crush their future free cash flow. They know it will artificially inflate their depreciation costs for the next decade. And they know there is a very real possibility that they might not see a return on this investment.
Okay, but if they all know it's financially toxic, why wouldn't one of them just say, well, you know what? We're going to pause, we'll let the others burn their cash, and we'll sit out for a quarter to stabilize our margins?
Because of the physical laws of compute scaling and AI.
Okay, tell me more.
In traditional software, a smaller team with better code could beat a tech giant. AI doesn't work like that right now. AI capability scales linearly with compute power.
Meaning?
If Meta trains a model on 100,000 GPUs, and Google decides to save money and only train on 50,000 GPUs, Meta's model will be objectively smarter, faster, and more capable.
Oh, wow.
There is no second place in foundational AI capability.
Oh, wow. So you can't out-algorithm a sheer lack of compute.
Exactly. The moment a company steps off the gas pedal, even for a single quarter, they risk losing everything.
Everything.
They immediately lose their enterprise clients who demand the smartest models, they lose their models' capabilities, and they hand the future of the internet over to their rivals.
Man.
They are locked in, they can complain about the high capital expenditures on earnings calls, but they cannot stop. It is no longer about greed or capturing new markets, it is purely about survival.
Which is such a dark way to view a $45 billion investment.
It really is.
It's not a victory march, it's a hostage situation. The money isn't the bottleneck anymore. The electricity is a bottleneck. The physics of latency is the bottleneck. But the hardest constraint of all is this psychological trap. Everyone knows continuing to throw money into this might not yield a return, but stopping guarantees failure.
And that dynamic fundamentally changes how investors have to evaluate these companies moving forward. We are about to witness a brutal filtering process in the market.
A filtering process.
Yeah. The ultimate winner of this arms race will be the one who can successfully convert these massive asset investments into future pricing power and scale advantages.
Right, and the losers.
But the losers are going to find out that they just spent hundreds of billions of dollars building incredibly expensive infrastructure for someone else.
Man, so as you watch this tech arms race unfold, and you see these mind-boggling numbers cross the news ticker, ask yourself this. If the ultimate winner of the AI wars spends hundreds of billions of dollars, ruins their free cash flow, and navigates all these physical bottlenecks just to become an overpriced utility provider for someone else's software, are they actually winning or just surviving?
That is the multi-billion-dollar question that the market is desperately trying to answer.
Thank you for joining us on this deep dive into the hidden layers of the tech economy. Keep questioning those headlines, keep looking closely at the cash flow statements, and we'll see you next time.